Hi everyone, Kathleen Brooks here, Research Director at XTB. It's been an inauspicious start for the week, with European stocks selling off sharply, particularly in France. The EU elections had a twist at the end. There was a big shift towards far-right parties, which wasn't unexpected. However, the French President Emmanuel Macron then called a surprise snap parliamentary election on the back of the results. This comes after his centrist party won less than half of the votes that Marine Le Pen, the head of France's far-right party, won. Financial markets immediately reacted. The euro-US dollar rate fell below its recent range, below 108, and has extended losses as we have progressed through this week. This pair is now back at its lowest level since early May, and momentum seems to be on the downside. European stocks are massively underperforming their US counterparts. The S&P 500 managed to extend gains and break to a fresh record high at the start of this week, although the Euro Stoxx index struggled, along with the FTSE 100. The FTSE 100 is underperforming the European index and has been lagging behind the European stock market in recent months, as you can see in this chart. European shares are dealing with a double whammy of bad news this week. Firstly, central banks are expected to delay cutting interest rates, which could hit corporate profits, especially in Europe. Secondly, the snap French elections are considered a referendum on President Macron's economic reforms. If Marine Le Pen's party perform well in the parliamentary elections, then labour market and economic reforms could be in jeopardy. France's credit rating was recently downgraded, and it has a budget deficit of over 5% of GDP. The market's concerned that if the economic reforms are abandoned, this could lead to market jitters about the French fiscal position, with France potentially suffering a market wobble, like the UK had after the Liz Truss budget. French bonds have sold off sharply on the back of the political turmoil, and the 10-year bond yield is now at its highest level since November 2023. We'll be watching French and European assets closely in the run-up to this election. This week, we also get the FOMC meeting in the US. The Fed's not expected to change interest rates, but we will get their latest economic projections and the dot plot. We expect them to downgrade the number of rate cuts they expect for this year. The last dot plot in March predicted 3 rate cuts this year, but the market now expects only 1 cut from the Fed sometime in November or December. We expect the dot plot to signal that the Fed is in agreement with the market. However, if they signal that they could still cut rates twice this year, then this would be a dovish development and could trigger a risk rally. And finally, there was some good news for the UK stock market. Raspberry Pi, the UK PC maker, listed on the UK stock market this week and received a very warm welcome from institutional investors. The stock market had a list price of 280 pence, however it jumped to a high of 390 pence on its debut, sending its market capitalisation rising to approximately £700 million. This is a positive sign for the UK market, as it shows that companies can derive value from listing in the UK. It's also a sign of how in-demand tech stocks are right now, even in Europe. That's all for now. Thanks for joining.